Welcome to Startups Decoded, where we uncover what it really takes to build and scale startups. I'm Andy Walsh, founder and strategist. Each week we will bring you actionable insights and real stories. Let's dive in. Hello and welcome back to Startups Decoded, podcast looking at growth, strategy, and insights we can gain from expert guests. And today we've got someone who's got a breadth of experience that I'm excited to learn more about. Ben Yoskovitz from Highline Beta. Welcome, Ben.
Thanks for having me, Andy. I appreciate it.
I always like to set up these conversations with understanding you, and the real theme that I'm seeing come through across all the episodes I've recorded now, we've got 8 live at the moment, more coming, of course, the breadth of skills that people have and the journey that they take. So firstly, I'd love to get a little bit of a top level on yourself as far as what you're doing now at Highline Beta and what Highline Beta does.
Sure. Yeah, happy to. So Highline Beta is a venture studio and venture capital firm. Essentially what that means is we're building and funding startups from scratch. I think for me, a venture studio has to be building and funding. In our model, we're working with corporate partners quite often, or family offices sometimes as well, where we're collaborating with them on the actual ideation, validation, and building. So we always think about how do we bring more ingredients to the table. So a corporate partner that could be the first customer or the first, distribution partner for a new startup. Maybe they have access to data or domain expertise that we want to leverage. So work with corporates, work with family offices to build and fund new startups. And I started Highline Beta 9 years ago, so it's been quite some time. But before that, I was doing a whole variety of different things. It's been like a mixed bag since I started my first company in 1996. Highline Beta, we have about 22 companies in the portfolio today across a few different industries and verticals. Both building from scratch and also pre-seed investing. So we're also doing both of those things as well. And so if we talk more about the venture studio model and how that works, quite nuanced, lots of different variety to it in terms of how people are trying to leverage this model to build good companies.
Yeah, and what you touched on there is critical in that breadth. And you started life as a founder. You've gone through an acquisition with Salesforce and then the venture studio ride. So that full gamut of what you're doing. And we had Neil Gosh on an episode recently. We were chatting before the show, and Neil did a great job of setting up venture studios, and he broke it down into 3 parts, which was the entrepreneur, who's the idea machine ultimately as far as early insights, validation, market opportunity. Second one being the operator, so who comes in to run the portfolio company, and the third being investment. And that's obviously into the studio itself, but also ongoing, how does a portco raise funds, which I love. And I think that your breadth of skills neatly lines up to that across the full range. So looking back from your career, you talked about 96 and your first journey as a founder. Was that fresh out of university for you?
It was while I was at school, actually. So I think between second and third and fourth year, I don't know. It's a long time ago, but started, first company in 1996. The web was just starting, really, right? The internet had existed for a while, but it was being used by academics and governments. So web comes out, we're talking Netscape era, and met a few guys that were trying to start a web agency, basically. So imagine a world where it was complicated to build a website, or complicated to build an e-commerce site, or complicated even to build a web application. I mean, that concept barely existed. So we started this small company doing that, ran that company for a while. We were acqui-hired by a bigger agency in the US in like 1998 or so, right before, the dot-com crash. So lived through that whole experience. Ended up starting another company in like 2007, which was a software company in the recruitment space. That didn't work out. Then started actually what really was a venture studio in 2010. We didn't call it that at the time because that terminology sort of existed but wasn't really popularized. And so we called it an accelerator. It was Year One Labs. We made 5 investments, and we were building companies from the very beginning, putting founders together, throwing ideas in. One of those companies ended up being acquired by Airbnb. So that was another interesting experience. Then you mentioned, working at a startup in product, where I was running product for a company called GoInstant that was acquired by Salesforce. So I went through that journey, spent a couple of years at Salesforce, then joined another startup where I was angel investing. So it's this mishmash of being a founder, running product and building software products, also being an investor, and then combining all of those things into the venture studio model and starting Highline Beta.
Yeah, and the theme that I love it because it resonates with me because it's who I am too. Every guest I've had has had the most, like, I'd say, bouncing around career. There's nothing linear about where they move. And I think that breadth of experience is critical today. And we'll definitely explore that in the episode as far as what skills you need to have as a founder today and how you go through to ultimately, either exit or create a commercially successful business. So for you, I'd love to look at today, if you were to give a founder advice, your one thing would be make sure that you have enough customers who have a problem with something that you can solve or an opportunity that you can create for them doesn't exist. For you in 1996, was that even on your radar, or did you just see an industry growing that you could be a part of and generate revenue additionally, or even before you graduated from college, right?
Yeah, there was no lean startup, didn't exist. I mean, it hadn't been codified, didn't really exist. We were really just trying to help businesses get onto the web. Like, that was the pitch. I mean, so again, it's so long ago, but that was really the pitch was, hey, the web is going to be big. People are going online looking for stuff. People are going online to buy stuff. You need to be on the web. That was the pitch. Some people understood that and wanted to be early adopters of that. Others thought that was insane. And I mean, people thought email wasn't going to be a thing. People thought email was a fad. So that was the era. So there was no rigorous methodologies, how to validate a problem, how to test things in market. Everything was also hard to build. So I'll give you an example. I remember very clearly building a e-commerce website for a company that cost about $400,000 to do. And by the way, I'm in Canada, right? It was $1.50 to a US dollar, right? So it's not like we were charging insane amounts. We were 22-year-old kids, but it cost $400,000 because building an e-commerce website was borderline impossible. And today you can, Shopify for $29.99 a month or whatever it costs. So the world has radically changed. The speed of everything was slow. So there wasn't a whole lot of rigorous methodology on validating a problem, testing and iterating, prototyping. It was just like, do you want to get on the web? Oh yeah, you do? I mean, we're talking about like Yellow Pages, like let's move the Yellow Pages onto the internet. Like that was the era I was playing in.
Yeah, and I heard someone summarize the evolution of the internet quite nicely as far as Web 1 being read-only. You talked about the academic approach, Web 2 being that two-way piece where you can contribute as well as find information, and then Web 3, which is sort of happening now, is this four-dimensional model where you're looking at blockchain technology, you're looking at independent authentication within that, and ways to create ecosystems that don't require sometimes a platform. And it's definitely a huge evolution in that. So your experience, you mentioned the acquisition within Salesforce. You're at GoInstant and you're a product person, right? Like that was 2007, I think.
No, that was later. That was 2012, actually.
Okay.
Yeah, 2012. Still a long time ago. That's still a long time ago now.
100%. And I think, 13 years ago, ultimately, for you as a product person then, compared to now, advice that you would give to your internal team, to your portco, boards that you're on, what are some of the big differences that you see from a product perspective on insights, development, build, validation, etc.? And then I'd love to be able to go deeper on some of those too.
Sure. Yeah. So I think fundamentally, the process is the same. So again, if you wind back a little bit before 2012, or in that range, Lean Startup, Eric Ries has written Lean Startup, Steve Blank has written 4 Steps to the Epiphany. I remember reading those books and being like, oh, that's how things are supposed to be done. That's how you're supposed to, test and experiment and learn rapidly. And then we applied all of those principles to Year One Labs, which was applying this lean methodology to building and funding companies. Then brought that to GoInstant. And so, I think that sort of rapid experimentation, prototyping, learning, all of that has remained actually basically the same. I think the difference now is maybe the speed with which things can be done has just gotten faster and faster and faster. So cheaper too, I would say, cloud computing and all of, so cheaper in a way, yes, but But I look more at the speed with which you can do things today, even compared to how you could do things, call it, 10 years ago, 15 years ago. And that's probably so methodology and how you approach it and how you, define your riskiest assumption and come up with an experiment to do that and run that. I think that's still the same for the most. It's the speed with which you can now do things, particularly, I guess, now with AI and what you can just generate and create with AI tech that allows you to go faster, run more experiments simultaneously, and try to increase the build, measure, learn cycle so that you can get to the right answers.
Do you think that we're at a point now that if you don't have any product experience, but you're someone who's an operator or you've worked in a big tech company before, that you could start a business without product experience and build something that's robust that you could make money off? Do you think that we're at that stage yet?
It's a good question. I'm biased because I am a product person at heart. And I've had this conversation with a few folks, including founders, who are like, do we really need product people anymore? What is the role of aren't they just an air traffic controller? By the way, air traffic controllers are super important, but it's a terrible analogy, I guess. But aren't they just coordinators? Aren't they just the people taking the requests and feeding the requests to the developers, and the developers build the thing. And I'm like, that's not really what product is about. It's really about the craft around what should get built, how it should work, how do you measure the value of the stuff that you're creating. So, I think the short answer to the question is, we're probably at a point, certainly from a execution level, where almost anybody can say, I have an idea, I want to build something. I use some AI coding tool to generate the web application or whatever it is that I want. I can build a website. I can connect Stripe. I can start charging money, and I'm in the game. So I think, yes, the short answer is literally anybody can do that. And you do not have to be technical or have product skills. I think to build the right thing for the right customer is still really, really hard. So just because I have more tools in the toolbox doesn't mean I know how to use those tools. And so that's where I think, whether you think of them as a product manager or you think of somebody who has now in AI, they're using this term that like taste, which might just be a human's way of defending itself against him or herself or themselves against AI. But I'm going to cling to it for a moment and say, like, who's the crafter of the thing? Who's the one that looks a customer in the eye, really understands what they need, and then translates that into the software that's getting built? That's still really, really hard to do. Because if that was easy and you and I could just build random stuff, we would just have, every company would be successful, which is not true. In actual fact, I'm not sure the success rate of startups has improved since the beginning of time.
Yeah, and if you look at historical data on PitchBook, I'm sure it would tell you the same story as far as fund success, founder success, and there's a little bit of scrutiny in the data that you would need to look at as well, as far as companies that don't go through fundraising that become independently successful as well. But what you touched on there for me is interesting. I've got one of my portcos I'm an advisor on. The founder is not a product person, and she's building a prototype to be able to get validation herself and then hopefully get early revenue, and then use that to inform where to go next, because finding the right team of co-founders is challenging too, right? If you've got an idea and you might have a marketing background, legal background, finance, whatever that is, finding the right co-founder from a culture fit and from a technical skills is really complicated.
Agreed. Yeah, totally agree with that. What I would say is there's no excuse now for somebody who has never built software before, whether from a technical design or product perspective. There's no excuse, just given where the tooling is today, for that person not to take a swing and do exactly what you've just described, which is, I have an idea. Maybe this person is a domain expert in a vertical, right? So they understand the market. And she says, I know what the pain point is because I've lived it. I just don't have the tools or the skill set to go build a thing. That's not a limiting factor anymore. I mean, you can use so many things. Like I've been playing with Lovable as an example, and Lovable is just, you prompt it and it spits out code. It's not perfect by any stretch of the imagination, but to get a prototype done, to put it into somebody's hands to see if you're in the right direction, like that's a couple of days of work now. And so there's just no excuse for saying, I have an idea, but I need a technical person. It's like, no, you don't. Or I'm a domain expert in something, but I've never built software, so I don't understand how to do product. It's like that, not a limiting factor anymore. To really craft something, to really build something, to build something that really works, that scales, I think that's a different story. But to prototype stuff, everybody can do that.
Yeah, it touches on an important topic as far as validation. And validation is more important than ever. And it feels like what these new platforms have opened up is the ability to get indicative feedback early around product solution fit. And if you can get revenue momentum on the early stages of launch from a product, and from an investment standpoint, all the VCs that I talk to are all saying the same thing, is from an investment point of view now, there's a lot more scrutiny as far as revenue growth and early impact rather than a concept. And that early stage category, like I hear a lot of talk around the fact that that early stage investment might start to disappear a little bit, and investors going back to what it was 10 years ago into the traditional sort of seed Series A round rather than the early stage. And people went back earlier and earlier to try and get better returns long-term with smaller investments. But that early revenue now allows someone to feel confident as a founder and operator, but also as an investor. Are you seeing the same kind of thing?
Well, I think what it opens up is the idea that not every business has to be venture scale, and not every business has to be funded by venture capitalists. So if you have domain expertise in a particular space, if you've done sufficient problem validation where you have some kind of insight and you know what needs to get built, and you can use the various AI tools and tooling to get something up and running, start to validate it, start to generate revenue, you might decide that that's not a business that requires enormous amounts of capital to scale, and you could operate that business quite successfully and maybe even profitably. So I think it unlocks those pathways to build those types of businesses. Always existed. I think people always felt like VC was the coolest thing to do. Go raise tons of capital, go for the big swing, go for the big exit. Like that was just the credibility and the cool factor of that. And I'm like, yeah, that's cool. I've seen it. I've lived it. It's cool. It's a fun experience. Raising millions of dollars and then burning millions of dollars and failing sucks, by the way, just in case anybody's unclear on that. But then, you know what's also cool? Just building a real company that solves real problems and making money. So to me, I think it's unlocked that. I think venture studios have emerged and are gaining popularity at that super early stage because of the recognition of just how hard it is to actually build the right thing, put the right brand on it, move things in the right direction. So again, even if I have the tools, I have all the prototyping tools in the world, but I really don't know how to validate something properly. I don't really know how to figure out what are the most riskiest assumptions that I have. I don't really know how to hire the next person that I need. Studios are there to be co-founders to those types of founders that need that type of support, and I think are playing that early role, both from a work product perspective, as in putting in effort, along with the capital that sometimes you do need to hire contractors or do other things or go to market tests. So I don't think pre-seed goes away. I think VCs, when markets wobble, VCs tend to go later stage because it just feels more de-risked. I think what happens is a proliferation of businesses that don't require as much capital, which venture studios can still play a role in because they're not necessarily always building venture scalable businesses, but also could legitimately be bootstrapped to enormous success.
Yeah, and I had Jeff Becker from Antler GP there in New York here with me, and he was talking about their thesis, and the way that they make assessments is they actually get a short list of startups in the office, and they're looking 2-3 month time to spend with them to understand founder fit, culture fit, their product a little bit more to make more informed decisions in that early stage. And they're having huge success on Fund 1 and going into Fund 2 at the moment. And it's fascinating to watch that space to sort of compare that model. And you touched on it a little bit in there. I'd love to look at now with product build and validation, venture studio versus a traditional startup. You touched a little bit there around experience internally. Sort of, how do you see the difference and I guess ultimately the value in a venture studio to be able to validate a business early, feel confident to launch it, and then make sure that it retains, I guess, good product health through that journey?
I would say that venture studios are meant to repeatably build businesses. So they should be more rigorous in how they do the validation. So, founders tend to have what I describe as a reality distortion field around them. They have an idea or a vision. They believe it's true. It hasn't been brought into the world yet, so it's net new. So there's no proof that it's going to work. But I fundamentally believe this thing is going to work, and I'm a genius, and we're going to make this happen. And when that reality distortion field gets so strong around a founder, they usually just run. They know they're supposed to validate. They know they're supposed to test. Like, come on, that stuff's been around for a long time now. But they just skip some steps. They just believe so much in themselves or their own vision. And founders need that to get up in the morning and fight the fight of building something that new. You need some level of reality distortion field. If it's too strong, you're probably going to run into a wall and crash. And so even though they know what they're supposed to be doing, they're just like, I'm going to skip. I'm just going to do this because I'm right. A studio is a more rigorous methodology. It says, no. We're going to follow these steps. We're going to, in a way, stage gate these things. We're going to have targets that we're trying to hit around certain things that we want to see done. We're not trying to take the art and the magic out of startups. We're trying to balance that with a bit more, call it science. And a studio, its whole job, and therefore the people that work at the studio should be experts at this because they're doing it all the time. They don't keep going with the startup and focus on scale. That's not their expertise necessarily. It's always that what I call -1 to 0, 0 to 1 phase. And so if they're experts at that, the rigor by which they do that, the standards that they set should be higher, which the hypothesis or the thesis is that by doing that better companies come out the other side of that process. And so to me, it's like everybody knows what they're supposed to be doing. It's a question of whether you do it and to what degree you do it or not.
Yeah, and it's interesting. I'm doing an episode soon on human behavior and the elements of pack versus tribe behaviors. A pack are people who have similar passions and they're a little bit more objective about what they're doing. Your tribe are the ones that are the ride or die, right? They'll do anything for you. So when you're in a startup and you have your tribe and everyone's so focused on the mission, it becomes an echo chamber of sorts, right? So you're self-validating what you need to do, whereas the objective conversation is ultimately as a founder, if you have an idea, you don't want to prove yourself wrong.
Yeah.
It takes a very pragmatic person to be able to have external feedback and challenge and question their own insights and passion of what they're doing. So it's a human behavior thing in the sense of how do you step outside of yourself?
Yeah, 100%. And I think that's where the studio provides the structure, the governance, the systems for being objective, running a good process. But again, also, like, as much as I believe in that process, I've also seen people and studios overemphasize the process to the point where it becomes factory-esque. Like, I don't believe venture studios are factories because a factory builds the exact same thing every single time. Whatever it is, right? Water bottles. It's the same water bottle every time. A toy, a food item. It's got to be consistent. Every single food item out of a factory is exactly the same. Startups are not like that. As much as we would like them to be maybe formulaic, they simply are not. There are too many variables. So I think I've seen some studios go so extreme on the methodology that nothing ever comes out the other side, right? Because you've set the bar so absurdly high, you'll literally never validate anything within a reasonable time frame, and then nothing comes out. I would say as committed as Highline Beta is, for example, to validation and doing all of that work up front, I don't think any startup has left the studio and not pivoted. So say it another way, every single startup that has left the studio has pivoted in some way. So what does that tell you about the methodology? So it might tell you that Highline Beta is terrible at it, which I don't think is true. It tells you that no matter how much validation you do early, the real truth comes when you build a product, ship it, get it to market, and learn from that experience. So there's a balancing act between how rigorous you are up front versus, how much, again, pack versus tribe. I think we need a combination of those things and some balance between them to make any type of startup work, even startups coming out of venture studios.
That makes a lot of sense. And I think being able to be using data rather than your own passion to be able to separate the two. And as you touched on there, the pack versus tribe, having a combination of both. You want someone who's very focused on that, but you also need to be able to take in different points of view, different feedback. And we all carry personal bias as human beings. There's things that we've learned and they could be 5 years old, 20 years old. And we need to make sure we're not leaning on old information and that we're very open-minded to change. And that pivot is critical, right? And I've been part of startups where we have multiple ICPs and you test and you have a hypothesis, but sometimes what you design and what you test goes completely a different direction to what you're thinking. And you might find product solution fit and get some traction, but it's not where you originally thought. So you're actively doing that, right? And being open to change is critical to success, particularly today where we're creating not just new businesses, but creating new categories as well.
Yeah, 100%. I think also, what I've learned as founder, working at startups, an angel investor, before Highline Beta, and now I guess a professional investor through the studio model. At the end of the day, any company that gets built is going to succeed or fail based on the founder or the founding team, let's say. It does not matter, again, some studios will build a full MVP, get traction on the product, and bring in an operator. And that's, that's going quite far. You bring an operator in, it's an existing, I still think even in that model where you bring in that, call it founder or operator, way later stage, the winning or losing is still dependent on that person. Like everything you've done up to that point, great work, fantastic work, appreciate the work. I don't know what the hell's going to happen next. So, to me, finding the right person, let's say the right founder / CEO / operator to join into that studio model, coming in at the right time with the right mindset, to your point around openness to the feedback, but also have to have some willpower. They're not just a donkey that you're just, you're not puppeteering these people. They have to go run these businesses. When they become portfolio companies that leave the studio's influence is minimal at best. So the quality of that person you put in place and when you bring them in is critical. And I think some studios de-emphasize that part because they believe so much in the process and the methodology and the early validation, as opposed to, they say, we've teed the whole thing up, you just have to run it, but you could be half brain dead and still win. I'm like, that's not true. It just doesn't work that way.
Yeah, and within that, there's something really interesting. Highline Beta is 9 years old, right?
It is. Yeah, it's crazy.
So in that time frame, have you seen any patterns around the optimal time to bring in an operator for your companies where you're seeing better traction? I know it's hard because every business is different and unique in category, but are there any things in that you've seen stand out?
Yeah, we tend to like to bring that founder / CEO / operator in early, for the very reason that we believe ultimately the success or failure of the business will be dependent on that person, or again, the founding team that you're putting in place. So we have less sort of belief or maybe hubris in our own ability to go build awesome companies and then just plop somebody in and say, here, you're hired, go run this thing. It's all teed up. You can just kind of work 10 hours a week and it's going to win. Like, that's not how this operates. So we like to bring people in early. We like to, I call it dating. We like to date that person for a while before we choose to get married. Married being start a company and put them in charge of that company. Difficult to extract them out of that after, once they're in there. Not impossible, but difficult and certainly awkward. So we like to bring people in early. Sometimes it's even within just the first few months. We'll do 3 months of our own research, validation, ideation. Again, sometimes with a corporate partner or with a family office. And we'll say, hey, we have enough sense that there's something here, but we haven't built anything yet. There's no product. There's no traction. Let's recruit somebody in who can really lead this thing, make them what we call a founder in residence. So they're a contractor to Highline Beta. We date for a while. If they're the right fit, if it's going in the right direction, incorporate the company, they become the CEO. A lot of studios will put 6 to 9 months in on their own dime before they bring somebody in. And then they believe, A, they should own a lot more equity. B, that person is more of an operator and not a founder. We like to try to bring in more founders than operators.
Yeah, and there's 2 things I'd like to build out a bit further on that. So one of them is culture and the psychology of human beings. The later you come in, the more your brain operates like an employee, where it feels like you're coming in to drive the ship of something that's already been designed, built, tested, validated. Whereas if you come earlier, there's a lot more sort of hustle and hacking that happens in those early stages where you get firsthand information yourself as a leader. You can choose a direction and you're sort of committed in a way. So I think that there's 2 different mind states that happen within those different timeframes.
Yeah, 100% there is. We've done both, by the way, and we will continue to do if we want to think of that as just two options. There's like all kinds of shades in there of different colors, but we've done both. We'll continue to do both. But yes, the further you take something as a studio, the more you're recruiting a CEO who is an employee and an operator. The earlier you bring that person in, the more they will have a founder mindset. That's just a natural thing. And sometimes you do want more of a CEO mindset than a founder mindset. So again, we do both. I certainly believe that there is no perfect way to build a startup. So again, back to this notion of a formula. If there was a formula, it would have been cracked and companies would have been, the success rate would be off the charts. So, I mean, even look at Y Combinator companies. Y Combinator, by far the world's greatest accelerator, insane quality of talent that goes into Y Combinator. I don't know that Y Combinator's success rate, maybe their outcomes, because, some of those companies go public and really scale, is amazing. Are they 6 out of 10 startups succeeding? I don't think that that's how that math actually plays out. So we don't believe there's a single methodology or formula for success. So we like to be opportunistic. Meet a great person who has an idea. Maybe we'll bring them into the studio. Work on our own thing with a corporate partner for 6 months, build an MVP, get traction, recruit a CEO operator for that. So we case by case with some parameters around what we believe is important to set things up for success. But we don't have as rigorous a methodology as some other studios do, because I've just seen too many different ways of winning, as well as too many different ways of losing, to suggest that there's one way to not lose and one way to win.
And anyone who's a founder currently or exited would 100%, I think, agree with you, is that there's no formula. And to your point, if there was, that success rate of 10% that is the average that's used in VC investments for success is like going to change, right? You'd start to see that number creep up. And I don't think it's shifted much at all in the last 5 years. And it's been obviously a very strange period from 2020 to 2025 on the investment front. But yeah, I think that's very fair. And then the second part of that I'd love to talk a bit more about as well is, if you're going for external investment, a venture studio acts like private equity. So you have your own internal capital that you're using to deploy to get that first phase. But ideally, you're pivoting to external investment or revenue from the company. Like when you go into the investment stage, the founder's role in that, as far as how much equity they have, culture fit, how much they've been driving that company from that stage, has an impact on external investment, because VCs definitely have a point of view around venture studios and can be sometimes skeptical about the commitment of the founder, CEO, operator within that company.
Yeah, totally agree. So I think, let's say historically, although it hasn't been that many years, VCs have not been a fan of the venture studio model. They will say things like, founder doesn't have enough equity. Okay, like it depends on the model, of course, but founder doesn't have enough equity, so they're not going to be motivated enough. I tend to be dismissive of that. I think that's more VCs saying they don't want someone else on the cap table who owns more equity than them. Because I've met people who have relatively small amounts of equity in things and are insanely committed, believe in it, want that thing to win. I've seen people who own 90% of a startup who are half-assing it and comfortable failing. So I don't think those things are causal. Amount of equity, amount of effort. Maybe somewhat correlated, but not causal. But every venture studio, for the most part, needs downstream investors to support these businesses. Even if you're trying to build revenue-generating companies, they're probably not profitable to the degree that you need. Someone else has to fund these things. And most studios aren't that deep-pocketed. So they're not funding it past Series A. So somebody has to fund this stuff, which means you have to set these things up to attract the right types of investors. So cap table matters. When the founder joined absolutely matters. What industry and vertical you're in will also matter. What types of investors you're trying to attract. And the recommendation I always give to a founder joining a venture studio is, if you meet an investor who's like, I don't believe in the venture studio model, just move on with your life. Because, at the end of the day, take venture studios out. Most founders, if they pitch 100 investors, will get 1, 2, maybe up to 5 of them to invest. So it's still a very few who will say yes to any deal. So the same math basically applies to venture studios. You just have to find the right investors that are comfortable with the model. But it adds a wrinkle when you go to raise more capital. You can't pretend that that's not true.
Yeah, and I've seen it firsthand myself, but it's easy to slip into that behavior of what you read. So if you're seeing lots of people talking about this conversation, you start to carry that bias into why you're being declined from a VC point of view. But talk to any founder who's fundraising, you're going to have obviously so many more declines than you will people who will even take a meeting.
Again, like, it's hard to get real data on this sort of thing, right? I'm not trying to be overly analytical about it, but I would say if you looked at the average decline rate for any startup outside of a venture studio, whatever that percentage is, it's high, right? 95%, maybe 99%, I don't know. Venture studios probably have the exact same rate of declines, right? Like of no's. So if the rate is exactly the same, you're keying in on a particular reason why you think investors are saying no to venture studio deals. I'm not saying that's not true. It doesn't exist. I'm not saying that's why some of them are going to say no for that reason. But these are the same investors saying no to 99% of the other stuff they see anyway. So it's not like everybody outside of a studio is getting funded. Oh, you joined a venture studio? Your chance of funding is impossible. Like that's just stupid. That's not how this works.
And when you look at 2024 data, from a straight VC perspective on PitchBook, in 2024, there were less deals done, but the average deal size was much higher, which means that VCs are scrutinizing more than ever on what they're doing, but the capital's still available. And I think for VCs, and there's great examples, in venture studios, there's great examples of companies that have been created, had investment, exited, had IPOs, etc. So it's how you sort of consolidate all that information and share it. So you touched on a little bit there, someone who is anti-venture studio, like being able to move on rather than change their mind and educate them.
It's not worth it.
Etc. Like I did an interesting test probably 6 months ago on LinkedIn, and I doubled down on venture studio content and the equity rates, etc. And it was really fascinating experiment in the comments as far as the trolls and the advocates and the balance of both and where it came through. And I never get trolled on LinkedIn, but I definitely had some people who were very anti what I was talking about.
Yeah. Well, and again, I think people have their own belief on how these things are done based on possibly a recency bias, confirmation, but the last company I did worked like this, so then therefore every company will work like that. Or I had a startup and I did it like this, and I was able to exit. So every company should operate that same way. But again, if you look at all the companies in the world that exit, and by the way, I think also, there's IPO level exit, there's $1 billion type exits, and then there's $10 million exits, both of which can be completely valid and can be completely life-changing for founders, investors, and employees. So there's like a wide spectrum of even what we mean when we say exit. But again, I don't know how many real patterns there are in those things, except for the patterns that you want to see. So, do I believe venture studios are the only way to build successful companies? Of course not. That would be a ridiculous thing to say. Do I believe they're a viable way to build good companies? 100%. Do I believe good founders or good founders and studios, but good founders can start a company in their garage, raise capital, and IPO? Yeah, because it's happened and I've seen it. Do I think that's the only way to do it? Of course not. So pick which way you want to do it for whatever reasons and run with that way. But, then when you're dismissive of how other people do it, I think that that's silly.
Yeah, and innovation comes from everywhere. And one of the 2024 trends was the dispersion of capital on a more global basis. So we're seeing emerging markets, and innovation in emerging markets is fascinating, right? Because you're having people that are seeing the world in different geographies with different challenges. They're at different stages of economic growth within their own country, etc. So innovation comes in very different formats. Like from a venture studio perspective versus a traditional startup, do you think that innovation looks different as far as their ability to create game-changing ideas? The venture studio model we've talked a lot about today has the validation process. It has experienced founders that have done it multiple times. Do you think that formulaic approach can potentially dilute innovation of someone else coming from a unique perspective, or do you think they're on equal par?
Yeah, it's a good question. I think you can use the venture studio model to truly build disruptive, scaled, gigantic businesses. So I believe that's true. I believe a lot of studios are modeled to not necessarily do that, which is okay, right? So more focused on earlier exits, more focused on real-time, near-term problems, as opposed to, inventing the future 10 years or 15 years or 20 years from now. So I think it's the answer is probably both. I think studios are probably more designed for shorter term, earlier exits, earlier wins. That's why you see them, like the data on studios that says we have a higher success rate, right? If we believe it's 1 out of 10 in startup land, it's 3 out of 10 or 4 out of 10 in studio land, right? But those 3, 4 are not category changing billion-dollar exits. And that's totally fine. But I do think you can still use the studio and studio models to go build category-changing businesses as well. It comes down more to how you design the studio, the model around it, the capital you have, the investors that you have in the studio. Like, are they really thinking long-term, or are they looking for shorter wins compared to maybe their VC portfolios? So it comes down to how you design the studio.
Yeah, and if you talk about exit value from memory, I feel like it's, again, PitchBook data is the average exit is like 230, 240 million. Within that, if you can exit sooner and have less dilution, then potentially you're going to get as much capital in your pocket as a big exit with like $1 billion exit where you're diluted so much. But then also there's a lot more time invested from a life perspective as well. So this whole notion of having to be a unicorn is not valid, right? If you think about the math and you compare them side by side, success comes in different forms if you're actually realistic around the numbers and the dilution.
100%. It depends on what you're trying to achieve. If you want to be famous and you want to be world renowned as a genius founder, however you want to describe it, you have to go and build billion-dollar businesses. If you want to take a swing at making a lot of money, so high risk, high return, but in a shorter time frame, you could build multiple companies in your lifespan, exit multiple businesses for $10 to $20 million. And if you did it quickly enough with low dilution, you will be insanely wealthy. Nobody will know you exist. Nobody will know what businesses you built. You won't get fanfare in the media. You won't be top 30 under 30 or whatever the hell else awards you're looking for, but you'll be rich if that's what your goal is. Now, you can also fail a bunch of times because startups are not get-rich-quick schemes, but there are just different paths to accomplishing different things. I've seen founders exit, sub $100 million and walk away with, insane amounts of money. I've seen billion-dollar exits where the founder didn't walk away with that much because of the dilution. And by the way, they spent 15 years of their life doing it. Now they're famous and they're regarded as heroes, but they're not insanely wealthy. And sub $100 million exits, insanely wealthy, nobody knows they exist. And that's fine, right? So depends on what you want out of it.
Yeah, great insight. And I'm going to be talking about that in another episode, in the sense of all these stereotypes that apply to a startup, as far as the long hours, the having to fundraise, and all the sequence of press releases that you see founders wanting to write. And the reality is like the challenge, I guess, or the question to them should be, do they actually add value to your journey? And what is ultimately driving you? Is it passion? Is it capital? Is it fame? Those things need to be thought through at the start if you're thinking about co-founder agreements and operator agreements to do that. But we're coming close to time, Ben. I would love to be able to hear from you as far as Highline Beta, what you're working on, and the type of people that you'd love to talk to right now.
Sure. Yeah, so what's interesting about Highline Beta, after 9 years, we've learned a lot. We've experimented a ton. I think going forward, and we'll be sharing this more over the course of the next year, we're really going to be focused on what we call vertical venture studios. So it's the idea of going into a relatively narrow vertical and building a few companies a year, let's say, in vertical 1, and then vertical 2 and vertical 3 and vertical 4. So when we think about Highline Beta and how it wins and scales, it's by creating more and more verticals and getting really good at building companies in each of those verticals. And because, again, if the venture studio model is about repeatedly building good companies, the playbooks for go-to-market, customer acquisition, business model narrow and simplify when you focus on a specific vertical, as opposed to, hey, we can build any kind of company in any kind of space. And, even insurance as an industry is too big, right? Because Highline Beta, we've actually done direct-to-consumer insurance. We've also built a startup in the enterprise insurance space. There's some leverage that you get one to the other, but it's minimal. So, our future is really these vertical studios that we build with partners. My answer to this is always founders, always looking for people who want to build new businesses, who are interested in the studio model. And then certainly, of course, corporates and family offices that also are looking at building their own venture studios that we could collaborate with. Those are the folks that we're always interested in talking to. And then I would say generally people who are curious about the venture studio model, because I do like talking about it, and not just to hear myself talk, but to promote the model as a viable way of building businesses, I think is still valuable to understand how is it really being done, because all studios are a little bit different. So, people who want to talk about studios, founders that are interested in the model, corporates or family offices that are interested in venture building, happy to talk to all of those folks.
Yeah, my personal experience in our conversations probably over the past year, it's like you're very open to listening, meeting, learning, etc. So I'd encourage folks to reach out to Ben. I'll, of course, put details in show notes for the episode, and when we launch, Ben will be part of the LinkedIn conversation that we have as well. So, Ben, thank you so much for joining today. This has been a really enjoyable conversation for me.
Yeah, thank you. I appreciate the time, Andy.
Pleasure. You're listening to Startups Decoded. My name is Andy Walsh. Please tune in every week. We're doing episodes every Wednesday. I look forward to seeing you next time.